Okay, let's jump right into this explainer, because today we're unpacking one of the most fascinating market paradoxes we've seen on the Asian exchanges in a long time. The market practically exploded with optimism, driving some truly massive gains across the board. In fact, the title of our analysis really says it all. KOSPI jumps 2.52%. A chip rally lifts the index. SK Hynix lags. But honestly, how does the primary engine of a massive market rally end up getting left behind in the dust? Well, to figure that out, we're going to have to look under the hood of global market mechanics, trace the flow of literally billions of dollars, and see how sometimes what looks like a classic sell-off is actually something completely different. The sheer magnitude of the day's move was frankly massive. The broader KOSPI index surged 2.52%, closing incredibly strong at 7,475.94. Now, what's really interesting is that the spark for this fire didn't even start in Seoul. It actually started over in Clay, New York. Micron Technology poured the very first concrete at its new fabrication plant more than 3 months ahead of schedule. And, if that wasn't enough to thrill investors, they went ahead and raised their U.S. investment plan through 2035 from $200 billion to a staggering $250 billion. That massive show of confidence sent an absolute shockwave through the global semiconductor sector, pushing the Philadelphia Semiconductor Index up over 3% and providing a huge, sweeping tailwind for the KOSPI right from the opening bell. And this vividly illustrates just how powerful that semiconductor catalyst really was. I mean, it was so intense it actually triggered dual buy-side circuit breakers. At 12:54 p.m., the KOSPI hit its 17th buy-side circuit breaker of the year. Now, instead of getting bogged down in the dense math, just know this happens when futures spike so incredibly fast that the exchange literally has to halt automated buy orders for 5 minutes just to let the market catch its breath. And then, just 14 minutes later, the tech-heavy KOSDAQ triggered its own circuit breaker. The sheer breadth of this rally was breathtaking. We're not just talking about a handful of tech stocks doing all the heavy lifting here. Out of 945 listed KOSPI stocks, 802 closed higher. Healthcare jumped 9.1%, construction was up 6.5%, machinery up 5.7%. It was quite literally a rising tide that lifted almost every single boat in the harbor. But right at the very heart of this incredible market momentum was a truly historic corporate event for SK Hynix. They officially finalized their NASDAQ listing, and the numbers we're looking at are absolutely staggering. The offering raised approximately $26.5 billion. Just let that number sink in for a second. That total officially shatters the legendary $25 billion record set by Alibaba's mammoth listing way back in 2014. The final price was locked in at $149 per share, which carried a 2.9% premium over their prior closing price in Seoul. And yet, despite that premium, the demand from investors was so ravenous that it exceeded the available supply by 7 times over. But here is where we hit that glaring paradox. If you picture the market heat map for the day, it is an absolute sea of green, representing that massive, broad-based rally we just talked about. You've got Samsung glowing in dark green, and almost every other sector is lighting up. But right there in the middle, the primary catalyst itself, SK Hynix, the exact company that just broke world records and sent global semiconductor sentiment soaring, is sitting there glowing red, closing down 0.27%. So it brings us to the ultimate question, doesn't it? If SK Hynix raised record capital, enjoyed demand that outstrips supply 7-to-1, and essentially lifted the entire KOSPI and KOSDAQ indexes on its shoulders, why in the world did its Seoul-listed shares actually drop? It feels entirely counterintuitive. In a normal market scenario, a record-breaking, massively oversubscribed listing sends a stock straight to the moon. But as we know, financial markets are incredibly complex ecosystems. To solve this mystery, we really have to look past the surface-level price action. To start untangling this financial mystery, let's contrast the fortunes of the two semiconductor giants on this specific trading day: Samsung Electronics and SK Hynix. On one side, we have Samsung, enjoying a solid 2.52% jump in its stock price. On the other side, we have SK Hynix, which is the current undisputed darling of the high-bandwidth memory, or HBM chip space. Those critical components that are practically powering the entire global AI revolution right now. Both of these titans are riding the exact same macroeconomic wave driven by Micron, but their stock charts for the day tell two completely different stories. When we break down the investor flow, our very first major clue jumps right out at us. Foreign investors dumped a staggering 1.7 trillion won of SK Hynix stock in a single day. Meanwhile, those same foreign investors were net buyers of Samsung Electronics to the tune of 194 billion won. Individual retail investors were out there aggressively buying the dip on SK Hynix, snapping up 1.21 trillion won, probably thinking they were getting a massive discount on a fantastic news day. Institutions were actually buying both, but that 1.7 trillion won sell wall from foreign investors, it was simply way too heavy for the retail buyers to overcome, which is ultimately what pushed SK Hynix into the red. But why? Why were foreigners selling so aggressively on such a great day? Well, the key to unlocking this massive foreign sell-off lies in understanding a financial instrument called an ADR, or American Depository Receipt. In really simple terms, think of an ADR like a financial passport. It allows shares of a foreign company, like our South Korean chipmaker here, to be repackaged into certificates that trade on American exchanges, like the NASDAQ. And critically, they're priced and traded in US dollars. This means a US-based investor doesn't have to stress about converting their dollars to Korean won, or setting up overseas custody accounts, or waking up in the middle of the night to trade during Asian market hours. It makes owning the foreign stock just as easy as owning Apple or Microsoft. And this brilliantly illustrates the hidden plumbing of the market that caused our paradox today. What we witnessed wasn't some sudden, panic-induced wave of pessimism about SK Hynix's business. Foreign investors weren't bearish on the stock at all. Actually, they were executing what's known as an ADR rotation. They were systematically selling their locally listed shares in Seoul, taking that cash, and using it to rebuild the exact same exposure in US dollars on the NASDAQ through the new ADRs. It was just a massive, highly coordinated migration of capital from one time zone and currency to another. And this wasn't some spontaneous morning of decision either. It was a highly calculated multi-day move. Notice how foreign investors systematically began selling off SK Hynix on 6 of the 7 trading days leading right up to the NASDAQ listing. By July 9th, the day right before the listing, the selling accelerated to 448 billion won. And then on July 10th, the day the ADRs actually hit the US market, the floodgates completely opened, and we saw that explosive 1.7 trillion won liquidation. They were literally just packing their bags and sold to move into their brand new home in New York. Now, if you want even further proof of this rotation theory, we just have to look at the nature of the selling itself. If this was a true, aggressive, bearish attack on the stock, we'd expect to see a massive spike in short selling, right? But short selling accounted for only a third of the foreign net selling volume, roughly 566 billion won. That means the vast majority, the remaining 2/3, was just institutions straightforwardly liquidating their existing, long-held positions. They weren't betting against the company's future. They were just freeing up the exact capital they needed to buy into that shiny new US listing. And now for the final piece of the puzzle, proof that the broader market absolutely loved the SK Hynix news despite the stock's red close. You just have to look at the surrounding ecosystem. Because the underlying business catalyst was overwhelmingly positive, the broader SK network, which wasn't subject to this mechanical ADR rotation at all, saw massive gains. SK Square, which holds a 20.5% stake in SK Hynix, surged 6.18%. The group's holding company, SK Inc., jumped 7.7%. Even key suppliers like Hyundai Semiconductor, which provides the vital bonding equipment for those high-end chips, closed up over 3%. The market clearly saw the immense value. It just couldn't express it in the primary stock due to that massive capital migration. So this leaves us with a really critical realization for anyone trying to navigate global finance. It is so incredibly easy to look at a red ticker symbol on a screen and immediately assume something is fundamentally broken with a company. But as we've seen today, market mechanics and the literal physical plumbing of how money moves across borders can completely mask the true sentiment behind an asset. The next time you see a seemingly inexplicable stock drop right in the middle of phenomenal news, ask yourself, are investors actually rejecting the company, or are you just watching the mechanical rotation of billions of dollars across the globe?